You have just got your salary. Should you first start an SIP, or should you pay back a loan or get insurance? You may also want to invest in stocks. I get it. It's all very confusing, and because of that, either you just spend away all your money or it just keeps accumulating in your bank account. So in this video, I'm going to share with you the optimal order of investing your money according to me, based on my 9+ years of being licensed in financial services in India and helping over 1,000 families. Your first step should be getting a private health insurance plan, even if you have a corporate health insurance cover. Now, I know this may sound very boring, but it is super important. That's because your ability to get health insurance is dependent on your health. So if you develop a major critical illness like cancer, or God forbid get into a car accident and suffer from brain injury, it becomes almost impossible to get a new health insurance. But if you have had a plan from the time that you were healthy, that plan stays valid and you can use it even if you develop a major illness later on, as long as you keep renewing your policy every year. That's because your health at the time of first buying the health insurance is considered, and no health insurance company legally can stop or discontinue your policy just because you have made a claim or have developed a major illness. Now you may be thinking, isn't my employer health insurance plan enough? Perfectly rational question, but the simple answer is no. That's because your corporate or employer health insurance is only valid until the time you're working at that organization. Now there is an option to convert it to a private plan, but then again, your health at the time of conversion is considered. And if at that point you have developed a serious illness, you would not be able to convert it and you would have no health insurance cover. And that can be a huge problem given the skyrocketing costs of hospitalizations in India. For example, in just 2023, India's healthcare inflation was 14%. Now at that rate, treatment costs will double every 5 years. So a hospitalization that today costs 5 lakhs will cost 10 lakhs in 5 years, 20 lakhs in 10 years, and 40 lakhs in 15 years. Imagine having to pay for all these expenses without health insurance and out of pocket. So get a health insurance plan today. And if you're confused about which plan to get, check out my course on health insurance. It includes a plan selection tool and draws on my years of experience since 2015 and having advised over 1,000 families. You can use the discount code HEALTH50 to get the course for $499 instead of $999, a 50% discount reserved for the first 50 people. The second step can also be the third step depending on your life situation. So if any person today depends on you financially or will in the next 5 to 10 years, get term insurance. Once again, I know this may sound boring, but term insurance will protect your financial dependents if you die prematurely. Just think about it. Your parents, your kids, or your partner, if they rely on your income and you are not there tomorrow, how will they survive? If you have a term insurance, on the other hand, the person you have named as a nominee, and you can have multiple nominees as well, will get a large tax-free amount if you pass away. In return for that, you have to pay a life insurance company a certain amount of money every year, and this is called a premium. And it's not even expensive. To give you an idea, a 25-year-old today would get a cover of 1 crore for around 10,000 rupees a year. A 30-year-old can get it for about 12,000 rupees a year. That's only about 1,000 rupees per month. And as a thumb rule, you should opt for a cover that is between 15 and 20 times your annual income. And I know that insurance is complicated, so tell me in the comments if I should make a dedicated video on how you can choose a term insurance and a health insurance plan. Your third step is saving at least 2 months of your expenses in a safe place. Again, I know this may sound boring. I haven't even talked about investing yet, but it's very important to create a very solid base for your money life. And having 2 months of expenses saved up ensures that you have some money at least for your unexpected expenses. It prevents you from taking high interest personal loans that are an absolute wealth killer. Now think about needing to book last minute flight or train tickets to visit your family for an emergency, or your work getting affected because your laptop or phone has just stopped working and you now need to buy a new one, or there could be a water leak in your house that needs fixing. It could be anything else. I mean, just look at the past year in your life and the various different last minute expenses that popped up. Having this money saved up for them gives you mental comfort and stops you from borrowing money from others or banks. Now, ideally, you want to have a larger emergency fund as well, but in my opinion, that comes in a bit later and you can build it over 1.5 to 2 years, and I'll get to that in just a bit. If you have noticed so far, the first 3 steps focus on survival and making sure that one big event does not wipe away all or most of your money. Step 4 is paying off high interest loans. We buy things we don't need with money we don't have to impress people we don't like. That's one of my favorite quotes from Dave Ramsey. And today we are living in a world where we think we can afford something if we can afford to pay its EMI. And because of that, people tend to buy expensive things by getting longer tenure loans because that's when the EMI reduces drastically. But that is a very, very dangerous way to live, because having too many EMIs is a sure shot way to stay poor. Your Instagram feed makes you look rich when you have all these material possessions, but in real life, you're actually not doing well at all. And what's worse is that you think that buying all these items and having this particular social status will make you happy. And it actually even does, but for a very, very short period. But what follows is a deep void that just makes you feel worse. So ideally, your EMI should not be more than 30% of your monthly in-hand income. And for me, any loan above a 10% interest is a high interest loan. That's because the Indian stock market has generated an average of 14% annual returns over any 10-year period. But that's just an average. So I've added a 4% margin of safety over and above that. So if you have a loan above a 10% interest, do everything you can to finish that loan. Stop eating out, stop buying new clothes, stop spending money in frivolous places. All your money needs to go into repaying that loan as soon as possible. In fact, let me show you the impact of high interest loans. So if you had borrowed 1 lakh rupees for 5 years at a 15% interest, then you'd have an EMI of about 2,379 rupees. Now, over this entire period, you would pay back that 1 lakh in principal and 43,000 roughly in interest, which equals to a total payment of about 1,43,000. So now let's see the same 2,379 rupee SIP growing at 15% annually for 5 years, how much that would become. So you have now 2.13 lakhs. So in the first instance, you pay 1.43. In the second, you have 2.13 lakhs. I know 15% is higher, but I wanted to compare apples to apples. Step number 5 is starting a monthly SIP investment. Finally, I've gotten to investing. Now, for a lot of people I know, investing would be the very first thing they do, which is actually not bad. But for me, covering your biggest risks first is the most important aspect in personal finance. When you're setting up your SIP, make sure that the amount gets debited from your bank account within 3 days of you getting your salary. This way, you're not tempted to spend that money elsewhere. And think about this SIP, that's why, as an absolute non-negotiable. So if you take a loan from a bank, you pay that EMI no matter what, correct? Because if you don't, the bank will come after you and you will get into trouble. Keep investing in SIPs with the same discipline and you will see how it will change your life. In fact, I'll share an example of a real life SIP in the Indian stock market. This is an SIP that was made in the Nifty Large Midcap 250 index. Let's see how much returns it has generated over the last 15 years. So 5,000 per month SIP since June 2009 would have grown to about 6.1 lakhs in June 2015, 10.7 lakhs in June 2020 and 39.4 lakhs in June 2024. And if you're unsure where to invest, then check out my YouTube video where I have shared with you 3 index fund ideas for a 1 fund portfolio. Step number 6 is also super important and in fact in a lot of cases actually more crucial than step number 5, and that is upskilling yourself. This can be done through taking small online courses or getting a higher degree or just spending time to develop a useful skill that can be monetized. And it could be anything, right from video editing, content writing, mastering AI tools and helping organizations apply them, photography, coding, painting, making websites and helping people get better at sales. The list is endless. But the idea of this is that you make yourself more valuable. Because in today's world, the process of making money has gotten democratized and it is directly proportional to the kind of value that you bring to the table. And when you have earned more money, you simply have more money to invest. In fact, if you increase your 5,000 per month SIP by 10% every year and everything else stays the same, you would now have 58.1 lakhs in 15 years as opposed to about 39 lakhs earlier. So dedicate a minimum of 4 to 5 hours every week to learning new skills. Follow your curiosity and aim to build a life that you never want to run away from. In fact, it's totally okay even if you lower your SIP amount every month because you're paying fees for a course or to learn a new skill. Over the last 12 years, I have personally spent an average of 2 hours per day on learning something new. And because I did not have much money when I was 17 or 18, I watched free and educational YouTube videos, which are an absolute goldmine of knowledge. I also joined Facebook groups of like-minded people, and interacting with these people who are far ahead of me inspired me, and more importantly, gave me actionable insights because these were people who had been there and done that. And finally comes step number 7, which is increasing your emergency fund to cover 6 to 8 months of expenses. Now aim to build this over 2 to 3 years as you're doing these other things in your life. So let's say you're spending 40,000 rupees per month on various fixed monthly expenses. That's around 2.4 lakh rupees considering 6 months of expenses. You already would have saved about 80,000 rupees because of step 3. So you need to save about 1.6 lakhs more. And as per my master calculator, so since we need 1.6 lakhs, I'll enter it here. And if you want to get here in 2 years, you need to invest about 7,000 rupees per month. If you want to get there in 3 years, you need to invest about 4,700, 800 rupees per month. So that is the range to build your emergency fund up to 6 months of expenses saved. And as you can see, this also factors in inflation. So as your lifestyle costs increase, so does the emergency fund amount. But we're already factoring that in through this master financial calculator. Now my 7-step plan here will ensure that you're on track to achieve well-rounded financial well-being. So try it out and I'll see you in the next one.